Layoffs sweep across the nation. Hey, everybody, my name is JJ. You're watching Bull, Boom, Bear, Bust, back with another dose of economic reality. Oh, JJ, you're just being dramatic. You're exaggerating. You're just trying to get clicks. You're fear mongering. No. Let's take a look at the headline. I'm being serious. Let's take a look here. Out of Yahoo, it's not just me saying this, layoffs are sweeping corporate America to kick off 2023, folks. We all knew this was coming. Is there anyone that is surprised by this? If you are, let me see your shocked face. Ready? You guys know those thumbnails where I try to make a silly face? I wish I could see your faces right now. That would be comedy. All right, none of us here are really making the shock face unless you're just doing it for comedy. We all knew this was coming, right? The consumer is busted. The savings rate of the typical US consumer has plunged to financial crisis levels. You all know that. What comes next? A major slowdown in the economy. It's already been slowing down, but now the next phase is entering massive layoffs. The next stage later this year is going to be a bankruptcy surge, a car repo surge, a home foreclosure surge. As far as the foreclosure thing, if sellers are smart, they'll get out by lowering their price more quickly instead of keeping it on the market and doing these little tiny price drops. All right, but back to this headline right here. More layoffs out of Amazon, and things are actually even worse than what Amazon had planned. Take a look at this. Do you guys remember the 10,000 layoffs during the holiday season just a couple months ago that were announced? I think it was October, November they announced it, but it was right in the middle of the holiday shopping season. Take a look at this. Another 18,000. Amazon CEO Andy Jassy said late Wednesday the company would cut just over 18,000, a higher reduction than initially planned. We also have Salesforce out there slashing 10% of its entire workforce. We have Vimeo out there cutting 11% of its workforce. And let's go back to a previous announcement here that we covered there. Goldman Sachs cutting about 4,000 bankers. Now, when it comes to Amazon, let's take a look at this chart and just look at the explosive growth in Amazon over the past couple years. Now, obviously, this chart goes back to 2007, and this is the workforce. And of course, we saw the company grow pretty steadily, 33,000 one year, 56,000, so they added 20,000. But since 2019, look at this growth. An addition of about 500,000 just from 2019 to 2020. We all know what happened in 2020 with the pandemic, the shutdown, a lot of people moving to a different state, relocating because of the health crisis, a lot of people working from home. So we had naturally a boom in online commerce, people buying office equipment. I remember looking for cameras back then, and cameras that used to cost like $30, $40 were like $120, $130. We had shortages. We had cargo ships off the coast backed up for miles. Not just parts and material shortages, but labor shortages. And things were backed up, but the online commerce was booming. So after we see this type of growth, and just look from 2020 to 2021, from about 1.3 million in the workforce to about 1.6 million. They added another 300,000 2020 to 2021. Now, I'm sure they're still compiling the 2022 workforce numbers, but now we're going to see this start to go down. And doesn't this look familiar? Doesn't this look like a stock price or something that just took off parabolically and then naturally it tops out? And now we're going to see the correction, just like a price correction in a stock. Now we're going to see the workforce correction, not just in Amazon, but a lot of different companies. So now it's going to drop. But again, no surprise to anyone here. This is what happens when the consumer is basically tapped out, when people are living on credit, aka debt, going further in debt every month. 70% of the population, even people that are homeowners, have a lot of paper wealth, but they're house poor, meaning their mortgage payment and the expenses of owning and maintaining that home are eating up a huge chunk of their monthly income. We have people out there paying 40, 50, 55, 60% of their monthly income towards their housing costs when you add it all up. Now, let's shift gears a little bit here. Do you guys remember the video that I did? I believe it was October or November of last year. I was out in front of the Bed Bath & Beyond. I said the aisles look messy, the store is unkept, the company's selling off a bunch of stock. The company began selling off a lot of their stock to pay off their bondholders, which essentially is their debt holders. And we told you in that video, this was a sign of big trouble. And look what the announcement is here recently. Bed Bath & Beyond, CNBC article just today, January 5th. Shares plummet after warning of bankruptcy. Folks, the writing was on the wall. We showed you the insider selling, the company selling off their shares. The aisles were unkept, just like Kmart many years ago when Kmart, before Kmart went under, we saw the stores unkept, messy. Same thing with Bed Bath & Beyond. So hopefully nobody here was holding that stock because we forecasted that several months ago. I know that when companies have dividends that they pay out, quarterly dividends, that holders of the stock are more likely to hold them even though the price is going down. But look at the mistake here for people that didn't get out of that stock. Just back in September when we were talking about it, it was up to between $12 and $13. We're at $1.76. So just over the past couple months, you lost another 50% if you were holding onto that stock. I wouldn't be in any retail stock right now. And some people say, well, Walmart is safe. Well, Walmart's not really gaining that much either, even though that's kind of the go-to place where a lot of people on a budget now are shopping. People that were shopping at Bed Bath & Beyond are going to Walmart. People that were shopping at more expensive stores, even stores like Kohl's, are now shopping at Walmart. You know, a lot of these people are moving down to Walmart. People that were shopping at Macy's, now shopping at Walmart. But even the Walmart stock, I mean, you would think that would be surging because more people are going there. But look, it was 143 last year. And here we are today, recently here, 143 and 53 cents. So holding this stock, you may get some dividends out of it, but you're basically treading water. Let's look at Target, a little more expensive than Walmart. You would think that people would be shopping at Target less and more at Walmart. So we see 1 year ago, we were at about $231. Today we're at $153. Wow, big haircut in that one as well. Let's go online here. Overstock.com was $53 about a year ago. Now we're at just under $18, folks. Look at all these stocks. All the people holding these stocks losing value very, very quickly, right? But we saw all of this coming. So I actually doubt anyone that's watching this program here today was sitting in any of these stocks because we saw all this coming a long time ago. Kohl's, 1 year ago, just under $50. It actually spiked up to over $60 at one point. We're down to $26, another 50% loss. So there you go, Bed Bath and Bankrupt. Again, shock face, right? Nobody's doing that. Nobody here is shocked because we saw this coming miles away. As I'm recording this, just before closing here today, January 5th on Thursday here, markets deep in the red. We've got Dow Jones down over 380 points, all major indexes in the red. The reason being Bed Bath & Beyond, right? So how many investors got caught basically flat-footed on this? And now this is causing a big sell-off, not just in the Bed Bath & Beyond stock, but throughout the markets overall. Folks, the Fed's out there saying rates are going to stay higher for longer. And it looks like the markets might finally be waking up to reality that the days of easy money and low rates are over. Markets were looking forward to the Fed pivot. Markets are forward looking, so they're looking forward for a pivot. But based on the language coming out of the Fed, they're going to keep rates higher for longer. Now, I still think that if something major breaks, something happens to where the markets come down, maybe it's World War III. I mean, there's a lot of channels out there talking about we're on the brink of World War III. The global tensions now are higher than we've seen in many, many decades. We have these sanctions. We also have this currency battle with a lot of countries out there now are de-dollarizing or trading outside of the dollar. Typically, trading outside of the dollar for countries historically has been a very dangerous thing, considering the might and force of the U.S. military. But now there's so many countries doing it, we can't possibly go against all these other countries with sanctions or acts of war. It's just too big right now. Countries are turning their back on the dollar more and more. They're trading in alternate currencies, trading amongst one another. Some of them even integrating gold into their trading. And we see the gains for gold have been pretty significant here recently. And certainly if you're sitting in precious metals right now versus in some of those stocks that we see down 50, 60, 70, 80%, you're sitting pretty right now and you're sleeping very well at night. And before we put a wrap on this one, let's talk about this article. This was put out via Bloomberg here. Car owners strain as more loan payments soar to $1,000, $1,000 a month for a car payment. Folks, this is where panic buying will get you. This is where chasing something will get you when the price is going parabolic and you're worried that the price is never going to stop coming or never going to stop going up. So you buy it because you think the price is going to be higher next year and the year after that. You have this FOMO, fear of missing out mentality. Many people had this, that prices were never going to come down. And that's a very big fear. And that caused a lot of people to pull the trigger financially, get a huge loan for a car. And now they have these $1,000 a month payment. Out of Bloomberg here again, the percentage of U.S. consumers paying at least $1,000 a month for their cars soared to a record. Wow. Concern that borrowers may be getting in over their head. You think $1,000 a month car payment's getting in over a lot of people's heads? Folks, we're just at the beginning. 2023 is going to be a very, very eye-opening and interesting year. There's going to be a lot of pain out there as well. But I think we're going to be prepared more than most here. Keep glued to this channel for more updates. We're going to stay on top of it for you with strategies, analysis, news, you name it. We're going to talk about it. If it has to do with money, the economy, finance, etc. Thanks everybody for being here. Big love to all of you. Bye for now and peace. Talk to you very soon.